Hi, I'm Elaine Sanchez, founder of Caregiver Help, and with me today is Brenna Baucum, a certified financial planner, and she is helping us put together this series of videos about life after caregiving and going solo. And in this session, we're going to be talking about something that to me is one of the most difficult and overwhelming challenges, and that is dealing with the taxes and the hidden financial landmines and how to deal with these things once a person dies. So, Brenna, first of all, thank you for your courage to talk about this and to help us through it. I remember I had to file my parents' final tax return upon my mother's death, and they had had a farm. They had farmed with my brother, so there were
Mm.
all of these things, and it was such a mess because it was a partnership without being a legal partnership.
Oof.
And yeah, oof is right. And so, having done that, and then having to do my Aunt Jean's estate, settling that when she was secretive. And by the time she was
Prizes.
90 years old, she had lost the ability to keep track of things.
Oh, God.
So I don't know if you remember, but she had these decorative screens in her apartment, and I thought they were decorative in the corners. And instead of being decorative, what she had in there were grocery bags that were stuffed with investment statements, with bank statements, with advertisements, with greeting cards. I found in there an insurance policy, and the beneficiary on this policy on Jean's life was a person I had never heard of. And
Yikes.
and so, I mean, I just when I think about taxes and the hidden financial landmines, holy mackerel.
It's PTSD for you.
A little bit, a little bit. So
Yeah.
I'm really eager to have you talk about this and help people maybe avoid some of the trauma that I experienced going through this. So let's start with I know that there are some tax changes that that take people off guard
hmm
after they lose a spouse or a parent or someone else. So what are these changes? What do they need to be aware of?
Yeah. Well, the very first thing that is true, regardless of the person who has passed, whether it's a spouse or a other family member,
Mhm,
is that there will need to be an estate return filed.
mhm,
706 is the number of that form, and it's a form that typically is filed with by your estate planning attorney in conjunction with support from any other professionals you may have on your team.
mhm,
So, an example I just had of a client who had this happen. Her husband passed away. We went through the process of collaborating between the estate planning attorney and me to get the final documents from their investments
mhm,
to be able to make sure those values were accurate.
mhm,
What within the estate planning documents are going to have different changes of a step up in basis is one thing we can talk about a little bit that
mhm.
happens,
It's important to do.
or or just kind of verifying. And between the three of us, the client had to do very little other than say,
Oh,
yeah, you
that
three
was
can talk to
good.
each other.
Yeah,
Yeah. And
yeah,
so rather than someone having to fish through baskets full of documents, again, this goes back to preparation as much as
yes,
possible. When that
yes,
information is clear at least one person knows about where all of this is in
yes,
addition to you, makes
yes.
it a whole lot easier. So that Form 706 happens to everybody, and needs to be filed within 9 months of the passing.
Mhm,
And then for spouses, there's a lot of financial changes that happen from a personal tax perspective.
mhm,
And one of the biggest that I think kind of slips the radar for a while when you're busy doing caregiving
Mm-hmm.
and taking care of immediate needs is now you are filing as a single person,
Yes.
not married filing jointly. And for better or worse, the IRS really loves people to be married and gives them a lot of tax benefits when they are.
Mm-hmm. Mm-hmm.
Brackets are compressed as a single filer. There are also cliff taxes that you might incur, meaning, if your income is 0 to 100,000, no tax. If it's 101,000, huge tax. Right? The cliff it's not a
Okay.
progressive
Cliff.
like
It
ours.
means like you're falling off a cliff here.
Exactly. Yeah.
Exactly. Okay.
Yeah. So there's things like that that kick into place. So it's just all of this change to be aware of. I've seen also people have big surprises when they are inheriting an IRA, whether it's from a spouse or a
Yes.
parent. And
Yes.
the rules are different between those two of, okay, do we need to take distributions versus not? And that changes your taxable income. So all sorts of pieces in there, all of which I could nerd out about and will nerd out about on whatever level of detail you would like.
Well, I think there are some things that people need to be aware of.
Yeah.
So, for instance, my Aunt Jean left me some United States savings bonds, right?
I remember those.
And
Yep.
yeah, and she had had those in a safe deposit box. So she bought them like 1,000 years before, right?
Right.
So when you looked at the value of them, the current value was like $42,000.
Mhm.
But what she had paid for them was so little, so there was a huge tax consequence to this because that's what you talked about, the step up basis.
Mhm.
So, so let's talk about where those things can come into play.
Okay.
And so should we be talking about how this inheritance affects the beneficiary's taxes as well as um, how, what you need to think about when you are getting this form 703,
6. Yeah. Yeah.
603? Yeah.
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 So
So there's two sides of this.
there are two sides of it, and spoken like a true veteran of the process, right?
Survivor.
You can see both sides.
Yeah.
So depending on how your estate planning documents are set up,
Hmm.
there may be an opportunity for a step up in basis if the first person passes based on shared assets.
Hmm.
So I'll use the client I just talked about a minute ago as an example. So she had a family trust in
Hmm.
her name. He
Hmm.
had a family trust in his name.
Okay.
And part of the estate planning thought behind that is to take advantage of what in our state here in Oregon has as a exemption of $1 million per person.
Okay.
So if they put them into two different trusts, we can take advantage of this exemption and make less money taxable from the estate planning perspective.
Got it.
Not
Hmm.
every state has an inheritance tax like we do here in Oregon, so that will vary a lot state to state on what is required. But regardless, the step up in basis is universal as an option. So for this individual, we had that trust, that family trust of the late husband,
Hmm.
and those assets all received a step up. So they were bought, this is kind of a great example of your savings bonds.
Okay.
They were bought at maybe 50,000
Hmm.
and now they're worth 1.5 million.
Hmm.
And all of that gain in there is taxable unless. So two, if he had taken distributions during his life, he would have been paying the tax on that difference.
Yes.
But at his passing, the step up in basis, what it does is it says all of these assets are now valued at his date of death, and it eliminates that
Yes.
gain in there, which is a
Yes.
huge piece of the
Huge
puzzle.
benefit.
Yeah,
Yes.
huge benefit to the beneficiaries, and in this case, to being able to access some of those funds
Hmm.
for income for the
Hmm.
surviving spouse without
Hmm.
having it be a huge tax. That she still has her family trust with a ton of assets and a lot of gain,
Right.
We don't necessarily need to mess with that right now because we have these other pockets we can pull from that are less tax
Yes,
sensitive.
yes.
So that's the step up generally in basis when you inherit. So if it was a parent or someone that you inherited from, that can be a huge benefit and comes through with our taxable types of accounts. So if it's a trust or a brokerage account or a TOD or a POD,
Yes.
all of those are words for similar types of accounts, a brokerage account after tax. IRAs work really differently. And maybe this is an okay segue to move into
A really good
kind of this.
idea to do
Okay.
that. Yeah.
So if you are inheriting an IRA from someone other than a spouse,
Mm-hmm.
then typically that IRA comes with distribution requirements.
Mm-hmm.
And it depends on how old the person was when they passed, whether or not they were taking required distributions from that
Mm-hmm.
account.
Mm-hmm.
And the required distributions are essentially the IRS's way of saying, we're ready to tax you now. You
Yes.
have thanks for saving on a pre-tax basis. That was really great, but now
Yes,
you're
nice.
in your early 70s and you need to start taking some money out.
Yeah.
So,
Yeah. And we want to share that.
and we want to share that exactly. So the that distribution schedule really depends on who you are, how old the late loved one was when they passed.
Okay.
But typically speaking, broadly, if it's a kid, a parent to a child type of inheritance, then that IRA needs to be distributed within 10 years of inheritance.
Oh,
And that's relatively new. That's as of
I
2022 in the
didn't
Secure
know that.
Act.
Okay.
You used to be able to drag it
That's a
out through your
parent
lifetime.
to a child.
Hmm. Yeah.
And like this IRA would be in a trust, is
It
that
would be, it's
assuming?
called an inherited IRA. So it would say,
Okay.
inherited IRA, Jane Doe
Okay.
for the benefit of Jimmy Doe,
Okay.
whoever the
Okay.
kid is. So it would
Okay.
still be functioning sort of in her name, in the late
Okay.
person's name, but the distributions would come to the child. And so
Okay.
those are 100% taxable distributions. And again, must be taken over that time frame. And so what I see people do when they inherit an IRA as a non-spousal beneficiary is
Uh,
say, let's try to spread the distributions over those 10 years
yes.
instead of taking a little bit each year and then a big amount at the end.
Got it. Got it.
So
Got
there's
it.
all sorts of strategies and ways. Sometimes people have reasons to do that for
Okay.
tax purposes, but that's
Okay.
generally what I see with parent to child type of inheritance.
Okay. Now let's talk about spouse to spouse.
Yeah. So oftentimes the default is when spouses have their own IRAs, they have each other as beneficiaries, as
Mm-hmm.
primary
Mm-hmm.
beneficiaries, and
Mm-hmm.
at passing, the beneficiary, the two IRAs become one of the surviving spouse. But
Mm-hmm.
that's oftentimes what I see happen. There are some documents you could have in your estate planning that allows you to say, you know what, I don't want my spouse's IRA.
Mm-hmm. Mm-hmm.
Give it to the contingent beneficiaries, maybe the kids or something, and
Mm-hmm. Mm-hmm.
that's a tax strategy for long-term estate planning
Okay.
moves. But in most cases, people need that income and need that account to
Mm-hmm.
support their lifetime moving
Uh-huh.
forward.
Uh-huh.
So if you have two IRAs separately that are $250,000 each,
Mm-hmm.
and then one spouse passes away and it becomes one,
Mm-hmm.
the minimum amount of what you need to take out of there goes
Yes.
up, goes
Yeah.
up,
Yeah.
doubles, right?
Yeah. Yeah.
So that is another thing we see impact taxes because now
Yeah.
not only is you have more income coming in at these compressed single
Yes.
filer tax rates.
Yes.
It's tricky.
It is tricky and it's really something where I think people need professional guidance.
Mhm.
Um, and the difference between a will and a trust is
Mhm.
really huge. Just real quick, because I had a traumatic experience with this as well. Let's talk about TODs
Mhm.
and PODs.
Okay. Yeah.
Okay.
So by their very nature, IRA accounts of any kind, a Roth IRA, a traditional IRA, have beneficiary designations available to them. So you can name someone as a primary or contingent with a percentage on how much you want to go to
Mhm.
those individuals. Brokerage accounts don't have that by default. So if you want them to function that way, you
Mhm,
can put them, or a bank account, put them into a TOD or POD type
mhm,
of titling so that they function that same way. When something happens to you, they go directly to whoever you have put in as a beneficiary without needing to go through the courts, through probate, through your will. Actually, beneficiary designations on accounts like that will supersede what's in your trust.
mhm.
So making sure they're all aligned is very important. But that's one way to streamline um, inheritance for people moving forward is to say, well, I'm going to do POD on the bank accounts because I want you to have that access for that money to settle the rest of the estate.
Right,
That can be one way to
right.
look at it.
So TOD is transfer on death.
Correct.
So that is sort of like being on a checking account with somebody that you have, like, once they die, then that money is yours.
Correct.
And it's not taxed.
Correct. So it's just a direct transfer,
Okay.
and typically in a bank account, all that money's after tax. I mean, there might be a little bit of interest going on
Got
there,
it,
but
got it, got it.
yeah.
Okay. And what is a POD? What's the difference between,
Hey, yeah,
oh, yeah, it's pay on death or transfer on
yeah.
death. So one thing I'd like to bring up about a landmine now is reminding people to really check their beneficiaries
Yes.
and make sure that who they want to receive this money actually they actually do receive it because things change. People get divorced, things happen.
Mhm.
And if you make a plan and you put all of these things into place and then you kind of forget about it and go on, the consequences can be surprising and sometimes devastating.
Yes, absolutely. And I think that we typically don't see our estate planning attorneys more than once every 5 years,
Right,
maybe
right,
10 years. A lot of
right.
people will wait much longer. And it's such a good point that beneficiary designations are relatively easy for you to change.
Yes,
Usually a form from your custodian or your bank, and
yes,
you can do that and sign it and it's done.
yes,
Whereas, and that's both a good thing and can be a dangerous thing if
yes,
there's someone taking advantage. But it does mean that from a trust perspective, you don't, if something happens with a loved one where you don't want them to inherit this money for whatever reason,
yes.
you don't have to go and rework your entire trust to change it because you can
True.
fill this form. So I always encourage people to talk through that with their estate planning attorney of what's the best thing for me to set through beneficiary designations for agility moving
Mm-hmm,
forward, and
hmm.
what are the things I really want to have within the confines of the trust.
So, quick painful story, and I'm
Hmm.
not going to dwell on it, but Aunt Jean um, and my Uncle Frank did not have children. So they set up, each one of them had um, an IRA account, okay? And so in 2008, and so in my Uncle Frank, he had, I'll call them brothers A, B, and D.
Hmm.
So he had brothers A and B as his beneficiaries. And in Jean's account, she had me and my other brother, brother D,
Hmm.
as beneficiaries. And then when everything happened in 2008, she decided to combine and put all of the money into one account. And the problem is that she moved the money out of the account in which all four of us were designated as beneficiaries and moved it into the one where brothers A and B were beneficiaries.
Okay.
And so when it was time for me to kind of figure all of this out, I realized what had happened. And one brother knew that that was not what she had intended, and the other one said, I think
Right.
she always did like me better than you two, and I think I'll keep the money. So eventually it all worked out, but I will tell you, um, it was a traumatic situation. And, we were fortunate in that, brother A decided to do pretty much the right thing.
Yeah.
And but it left some scars, and you don't want your loved ones to have to go through this kind of trauma when they're dealing with everything else. It's just so if anybody is listening out here, if you haven't looked at the beneficiaries on any of your assets, please do it. If you love your family, do it.
Yep.
Get her done, as they say, right?
Absolutely. Yeah.
Yeah.
You think about, I mean, and it's kind of the premise of this whole series is we have grief and money together, two things
Yes.
that are really complex and in some ways
Yeah.
kind of taboo. Like there's all
Yes.
sorts of expectations of what you should or shouldn't be doing when you're grieving with your
Yeah.
money. And when you layer those things together and add family on top of it,
Yeah.
I mean, it does really have all of the ingredients for being painful if it's not
Yes.
crystal clear.
Yes, and for creating conflict and hard
Yeah.
feelings between family members. It can be really awful. And I know a lot of people, and this is just a plug for pre-planning, that they don't want to make a will or a trust because they think if they go and do it, they're going to die. And my response is, yes, of course you're going to die.
Yeah.
But it's not because you you did the paperwork,
Yeah.
but this is the way that you can control what happens to your investments, to your home, to your money, to your possessions. If you want to be in control of that, you need to make a plan, and you need to do it while you still have the capacity to manage it. So, um, oh, I forgot to ask you something that I really wanted to talk about. Sorry, as you know, this was a traumatic topic for me. So
It's
thanks for
okay.
walking me through that and coaching me and letting me uh, retrogress, I guess,
You're fine.
regress. So can you explain how tax brackets and Medicare premiums can be affected?
Sure. It's we talked earlier about the idea of a cliff tax,
Yes.
and there aren't many of them, but the one that sticks out in most people's minds is Medicare IRMA surcharges, income related
Oh,
retirement.
yeah.
I'm trying to remember what all the acronym
Yeah.
stands for,
Yeah.
but it's a Medicare adjustment, essentially.
Yes.
It's a surcharge that's applied to you if you have over a certain amount of income. And
Mhm.
so for couples,
Mhm.
again, married filing jointly, if you make under, I think it's about $220,000, you're
Mhm.
paying the baseline for your Medicare Part A, I'm sorry, Part B and D premiums,
Okay.
baseline payment that everybody pays. If you make over that, then you get another little tack on to how much you pay for Medicare premiums.
Okay.
And then there's a progressive schedule that goes higher and higher and higher depending on how much you make.
Oh.
So if your income from pensions or Social Security or investments pushes you over that 220 mark, you're paying a little more.
Mhm.
If you've lost your spouse, you're
Mhm.
now a single filer, but some of that, maybe you had a survivorship, 100% survivorship benefit, maybe your investments are kicking off a lot of income. Your low end of that bracket is now 109 as of this recording that changes a little bit every year.
Oh.
So you might be in a couple of different brackets, meaning your Part B and D premiums are quite a bit higher.
And
So
what could that be? I mean, how high can those go?
usually it's by increments of between 40 and $60.
Okay.
On the top end, it's a
Mhm.
lot. It's several $100s more than what
A
you might
month.
be paying.
Yeah.
Yeah, per
Yeah.
month, and which is thousands of dollars per
Yeah.
year.
Yeah.
And sometimes that's the thing that you don't really know about until you get your letter, your Social
Yeah.
Security
It's like,
in
what?
October that
Yeah.
says, "Hey, here's what's happening next
Yeah.
year.
Yeah.
We've made an adjustment to your Medicare premiums and use if you want to." I've had a couple try this, a couple of people try this. There is an ability to refute the charges based on a
Okay.
change of life event, but the if the change of life event is that you lost your spouse, but your income is still over that amount, they're going to say sorry for your loss, but you
Too
still
bad.
have to pay it.
Yeah. Yeah.
Yeah,
Yeah.
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 So anyway, that's just one of those landmines that are sitting out there to keep an eye out for.
Yeah.
Yeah.
So, what I'm taking away from this session is that um, this is something a person shouldn't try to manage alone. The taxes and the hidden landmines, it's, you don't know what you don't know. And it is so easy to make a mistake, and to not understand what you need to do because, most of us are not CPAs or certified financial planners or attorneys.
Mhm.
And unless you are, this stuff can get very complicated and it can be really easy to make some very expensive mistakes.
Absolutely. And I think even in this transition filing from married filing jointly to single, even if you do file your taxes and you enjoy doing that work, I don't know
Mhm.
very many people that do, but some people do. Um, it might be helpful to bring in a CPA even just for the first couple of years,
Yes.
right? Just to, it doesn't
Yes.
mean you have to do it forever, but to have
Yeah.
somebody walk you through and be able to keep an eye out for some of these things, that might be a valuable consideration.
Yeah. Yeah. It could be.
Yeah,
Well, thank you so much. This is one of the tougher topics.
yeah, it's meaty.
Yeah, yeah, it's very meaty. And I appreciate you walking us through it and helping us understand it and listening to my personal story of woe. And I don't say that to get sympathy. I just say that I just think it's important for people to really think about what can happen
Yeah,
in a family if you don't get these things taken care of, when you have the opportunity to. So this is our ongoing series of Life After Caregiving and Going Solo. Brenna Baucum, thank you so much for being here again, and we will continue it. We have some meaty topics still ahead, so
we sure
thank you
do.
so much.
Thank you.
Okay, bye for now.